This video covers Chapter 6. According to your text, the title of the chapter is Efficient Capital Markets. I think it's a little misnomer, the title. I think the title should be Efficient Capital Markets with a question mark. And as I go through the chapter, you'll understand why I question the efficient capital markets. Now, this concept of efficient capital markets is important for you as an investor. You will periodically come across people who claim to have beat the market and have the ability to beat the market in the future. And you need to be armed with questions to refute or to, just to ask and to get more information from the person claiming to beat the market. And so that's what this chapter is about. It's going to give you the information that you need to ask the right questions about beating the market. And you'll find that when you start asking these questions, the people who claim that they can beat the market, they often fold up pretty quickly because they can't answer your questions, and the questions you'll ask will be quite good and they'll get right at the heart of the issue. So let's jump right into the material. The efficient market hypothesis really gained steam back in the late 1960s, and in 1970, an individual named Eugene Fama at the University of Chicago came up and defined the efficient market hypothesis by using relevant information types. Now, Fama came out with this article in 1970. In 2013, he is now a Nobel laureate for the material that's covered in a lot of this chapter. So he's considered to be the father of the efficient capital markets hypothesis. Now, like I said, how do you go about operationalizing the efficient capital markets? How would you go about analyzing efficient capital markets? It seems kind of abstract. Well, that's where Fama's work came in. Fama looked at relevant information. And that's relevant information is what he used to define three forms of market efficiency. Okay. The first form of market efficiency is called the weak form. And the weak form says basically that current stock prices reflect all information contained in past stock prices. In other words, this implies that there's no benefits to examining past security prices. The weak form basically says, look, if you look at past stock prices and you're looking at past trends, which is very common for people to do, if you're looking at past trends and you see the stock going up, it's no indication that the stock is going to continue to go up and that momentum would continue. Basically what he's saying is, look, if you do see a trend, right, then anything could happen in the future. You can basically put around here at this price a normal distribution around the expected future price, and there's a probability that it's going to go up, there's a probability it's going to go down, but most of the probability from that distribution is going to tell you that most likely the price is going to be relatively close to where it is now. And so the weak form of market efficiency set, the relevant information set here is past stock prices. And from past stock prices, you can compute returns. Remember, PT plus 1 divided by PET minus 1, that equals your return, the capital gain component at least. So weak form says you can't, if you're looking at patterns, past stock price patterns, for example, it doesn't have to be a nice, easy trend like that. It could be, for example, you can't extrapolate and say, look, okay, I recognize a trend, I see a pattern, I'm just going to extrapolate further. So the weak form is basically saying, look, people at this point in time, people have already reflected this information in the stock price. In other words, the stock price right here already reflects this pattern. The stock price on this upward pattern here, this upward trend, already reflects this pattern. So take a look at this pattern, for example, this upward trend. You're right here and you're saying, oh, I spotted this trend. I think the momentum is going to continue and the stock's going to go up. What makes you think you have information that the rest of the market doesn't have? Do you have some type of special information nobody else has? And the answer is no, you don't have information. Anybody can, even a child could look at a trend and look at past stock prices in the charts and see that, and come up with the same conclusion. So looking at a trend in and of itself, whether it's this form, what I would call a mean reverting trend, because it's kind of indicating that it's reverting to a trend, a mean back and forth, or an upward trend here, or it could be a downward trend. There's no information content that everybody else doesn't have. So you have nothing special. So what makes you think that you have this great insight? You're sitting here and, there was somebody back here who figured out the trend before you did. And there was somebody before him or her who figured out the trend before them and before them and before them. And you realize that somebody figured out the trend and spotted a trend way back here. And all that trend spotting, it's already been reflected in the stock price. So therefore, past stock prices and returns and their patterns have no value to predicting the future market. That is the weak form, and the relevant information set is past stock prices. The second form of market efficiency is called the semi-strong form. And the semi-strong form says that current stock prices you can see right now, not only reflect all the information that's embedded in historical prices. In other words, not only does it reflect past patterns and trends, but it also reflects all publicly available information. What is publicly available information? Well, things you might get off the web, things you would get from the Federal Reserve, from various public databases, the Wall Street Journal, magazines, newspapers, the annual report of the company. All of that information is publicly available. And what the semi-strong form says is that this information is embedded in the stock price. So if you go to the annual report and you find some information in the annual report and you're going to trade on it, well, you better think again, because according to this hypothesis, all that information is already reflected in the stock price, and it won't be any good going forward. So the relevant information set is all publicly available information. And it goes on beyond, and this semi-strong form goes a bit beyond all publicly available information. It says not only does it reflect all publicly available information, but it reflects it quickly, meaning that when there's news that comes out about a stock, the stock price reacts quickly, very quickly, to adjust to the point where, unless you're a market analyst and sits at a screen all day watching various stocks, you're going to miss out on being able to capture news and make a return off of it. So here's what I'm saying is, if there's the absence of news, stock price in theory won't be changing very much. So here we got time, and here we have price. So a stock in theory won't change very much if there's no news coming out about the stock. Okay? Because what this is saying is new information is what drives the stock price. So let's say at time t here, there's new information. This is when news comes out. News. Well, let's say it's positive news. That's going to cause the stock price to jump up quickly, right? And then if there's no additional information, the stock will continue relatively unchanged into the future. Okay? That is an example of efficient markets. Now, you can see this with individual stocks. Suddenly something comes out, new information comes out about a particular stock. The stock will jump or it'll drop down if it's negative news. You'll see this when the Fed announces at 2 o'clock on a Wednesday new information about the markets and their insight when they do a press release. You'll see the stock market going up or down when there's dramatic new information. Now, there can be times when you won't see you won't see an immediate sharp jump in a stock price. And it doesn't necessarily mean that the market is inefficient. Let me give you an example. The market would be inefficient if, say, you're traveling along and the stock has no news, and all of a sudden at time T there's new information that comes out. If the stock did this and adjusted very slowly to this new positive information, you could say, look, that's an example of market inefficiency. It took the market a long time to, quote, digest this news, to bake it in, sometimes is the slang used on Wall Street. It would take a while. You could try to, so this would be, this curved line would be an example of an inefficient market under most circumstances. It can, however, represent, by the way, an efficient market. And here's an example. In some cases, the news that comes out from a country or comes out from the Fed or comes out on a particular stock or stocks, for example, in mergers and acquisitions, that news may be quite complicated. And if it's quite complicated, the market may react briefly to it, but it may take a couple of days of asking questions and research to find out what that news really represents. And so it may take days for the market to react to that information. And so that could be an example of a slow reaction in an efficient market. It's just that it takes a while to process the new information. Okay, so that's the second form of market efficiency. Now, that said, most people believe that the market is reasonably weak form efficient and reasonably semi-strong efficient. And I say reasonably, I'm not saying that it's perfectly efficient, I'm saying it's reasonably efficient. There is a third form that kind of goes a bit too far, but as you see, there's a reason for this third form. Let me explain the third form. The third form is called the strong form of market efficiency, the strong form of market efficiency. And this maintains that not only is publicly available information and trends useless to the investor, but this form says that all information is of no value to an investor. All information. So that's the relevant information set that operationalizes a strong form. We know that this is too strong, and the reason why we know that it's too strong is because there's all sorts of insider trading laws, for example. If you have insider trading information, you know that that's useful. That's part of all information. And so this form says that if you have insider information, information that the president, the CFO has, information about mergers and acquisitions, information that the Fed has before it releases, this form says that it's all of no value because the market has already considered it and thought about it and projected it. And again, most people think that it's too strong. So the strong form market efficiency, almost nobody believes in this as being a realistic form of market efficiency. Now, why do you have the strong form? Well, we have the strong form for a reason. The strong form helps complete the information set that we're talking about, the information set. So you can think of this, the weak form. The weak form's relevant information set is past stock prices. So this is the weak form information set. And then you have the semi-strong form. And the semi-strong includes, remember, the semi-strong form includes, not all, but publicly available information, if I can spell that out right. Okay? Semi-strong form includes publicly available information, which includes past stock prices because all that's published on the web and easily accessible. Okay, so there's a third information set, and that's all information, and that's where the strong form comes in. So the strong form completes the information set of relevant information that's available. It could be past stock prices, it could include all publicly available information, which includes past stock prices, or it would be all information, which includes past stock prices and publicly available information, and even insider information. Okay? So that completes the information set. Now, that's interesting. That's of value. Let's go on to another form of market efficiency. Another way to look at efficient markets, and that's called the random walk hypothesis. Okay? The random walk hypothesis. Random walk. Okay? The random walk hypothesis basically states that price changes, and I'm talking in terms of stocks. Much of what I'm saying applies to the bond market and applies to commodities, applies to other markets, although there's idiosyncrasies in some of those other markets. The stock market is probably the best market to talk about here in terms of market efficiency. So the random walk hypothesis, sometimes I just call it RWH, it says that price changes, stock price changes over time are random or independent, which means that the return you get, the return over the last week or the last month or the last day or the last year will tell you nothing about what's going to happen in the future. The past is independent of the future is what this random walk hypothesis is saying. And again, remember, it's talking about price changes, not the actual price, but the changes in the stock price. So I'm saying, you know, when the stock goes from 60 to 62, that's a $2 change. Okay. The price changes are random. Now, that's an interesting concept in and of itself. It's basically telling you, look, if you find past patterns, those past patterns have no value in the future. It's just not going to help you because the market's going to follow a random walk. Okay? So this random walk hypothesis, it's not eliminating the idea that there may be past patterns. You can find, you can define a pattern almost any way that you want to define a pattern. And if you go back in time with thousands of stocks over thousands of time periods, if not millions, you're going to find various patterns. But this random walk hypothesis is saying it's going to tell you nothing about what's going to happen in the future. Now, that said, there's an important relationship here that we should look at between the random walk hypothesis and the semi-strong form. The two are related, and it's important to understand that they're related and they can be reconciled. So, random walk hypothesis, I should back up a second. The random walk hypothesis is consistent with the weak form. It's consistent with the weak form because the random walk hypothesis says, look, stock price changes are random, and the weak form basically says that past trends and patterns in stock prices are of no value. So that's easy to reconcile. It's an easy one to reconcile. What's a little bit harder and far more insightful, as I was saying a second ago, it's the semi-strong form and the random walk hypothesis. These two lead to quite interesting conclusions. And what it says is that, look, if all information is embedded in a stock price, so here you have a stock price, it's changing over time. So here you have a stock price, it's changing over time. If you're looking at this stock price right here, it reflects all all publicly available information, all new information. It's already included in there, and that information reflects people's best guess as to what's going to happen in the future. So you're right here at time t. Here's today, time t. So you don't know what's going to happen in the future, but this price reflects all publicly available information, and it includes expectations that people have made, forecasts that people have made about the future, about future interest rates, about future earnings, about future central bank actions, not just in this country but around the world, inflation expectations, so on and so forth. So if that's the case, if the stock price reflects all publicly available information, right, then what it's saying is the only thing that's going to cause stock prices to change between now and some point in the future, put it right here, some point in the future, okay, the only thing that's going to do this is new information. The only thing that's going to change this stock price is new information. If the information comes out as positive, it's going to push the stock up. If it's negative, it's going to push the price down as you approach this future time period. Now, what does that really mean? Well, it means that, think about it, the only thing that's going to change the stock between now and the future is new information. By definition, new information, news, is unpredictable. If it wasn't news, if it's truly news, you won't be able to predict it. And so, by definition, news ought to be unpredictable. And so, if stock prices reflect all available information right now, the only thing that's going to cause the stock price to change is some new information that's unpredictable by definition. Then you can't really predict what's going to happen to the stock. So that was an extremely important concept that took a long time for financial economists to unravel the mystery behind this. That, how could the random walk hypothesis, right, be consistent with the various forms of market efficiency? And so it's consistent with the weak form, which is easy to see. Semi-strong form is a bit harder to see, but still extremely insightful to realize that, look, you're playing a game of stock track, you're buying and selling stocks, you're buying a stock, you really don't know what's going to happen to that stock between now and the end of the semester because you can't predict the news out there. It's not news if it's already predicted. If you've already anticipated, it's not news. So the point here is that you may have a news release, a release of news. It may be showing up on the 5 o'clock or 6 o'clock news or CNN or CNBC. It may be showing up there and they may be calling it news, but if it's already anticipated, it's not news. It's only the unanticipated component that is news. Unanticipated, which you can't predict, obviously. Okay, so now that is the main gist of efficient markets and the random walk hypothesis. Now what I want to do is cover a thing called the efficient markets paradox. Efficient markets paradox. You might ask, if markets, if markets really are efficient, then why do brokerage firms and financial institutions and even why does CNBC even exist in the Wall Street Journal? Because look, all this information is embedded in the stock prices. What's the use? Why do any research? Why look at? Why buy databases and information? Hire analysts to research stocks when it doesn't matter? And that's a really good question. According to Grossman and Stiglitz, by the way, is also a Nobel laureate. According to their research, what they are saying in their research is the market is informationally efficient. Notice, I've been talking about information a lot since I started talking in this video. Information is important here. But what they're saying is, Grossman and Stiglitz are saying, is that, look, the money spent, the marginal cost, the money spent to research and to try to track down good buys in a stock can be earned back by additional returns to the point where you break even. So what I'm saying is what they're saying is the marginal cost of doing research is going to equal the marginal benefit which means from an economic perspective, you're right back to square one. Okay, but so then again, ask the question: why do research? And as I say in my notes on page 3, I think there's several reasons why firms do research and investors do research. Some people and investors are overly confident about their ability to beat the market. I see that a lot. I talk to people who claim to beat the market. You'll hear them on CNBC. I'll hear them in the classroom. That they're pretty sure that they can beat the market, and they got this method, or they have this skill. And so they're going to do research regardless of what the research says. They're going to do their, what these academic papers tell them. They're going to try to beat the market anyway. Another reason would be is that educated gambling turns some people on. Just like people know, look, they go to Vegas. They know the house is, the odds are against them and they're in favor of the house. But it doesn't stop, millions of people visiting Vegas and trying to beat the house. And so I would call that educated gambling, and it turns people on, and they may be getting thrills from that. And they're not, some of it may not be. We're not really capturing it in the world of finance. It's a human behavior element. Normally, we think of people getting gains from, in terms of returns, but they may be getting more than just dollar returns from trading stocks. They may be getting some high off it, which is what gamblers get. The things, they actually get a value. A gambler would see value in gambling because they're getting something besides just a dollar return out of it. Okay. Now, the other thing would be, third thing here as to why firms do research and investors, is that maybe some big investors may be able to squeeze excess returns out of the market via economies of scale. But that only goes so far, remember, because think about it. If you're a big player, you find a stock that's undervalued, and it deviates from what the fundamental value, what you think the stock is really worth, then if it thinks it's undervalued and it buys it, price impact, the fact that you're buying the stock and buying lots of it's going to push the stock up to its fundamental value. And so after a while, you won't get any benefit, any gains out of it. So it's not like you have infinite ability to get these gains. Price impact is going to cause you to lose the marginal benefit over time. Okay. There's also a fourth reason, and that's called window dressing. Firms pride themselves on having in-house research departments with knowledge and expertise in valuing stocks, even if they can't produce above average returns. I mean, think about it. Let's say you have no idea about the market and you go to a brokerage firm, a large financial institution, and you're talking to brokers and investment planners, and you don't have an idea of what you want. So you ask them, what do you think I should buy? What do you think's a good buy right now? And these guys are pretty smart at the financial institutions. They're not going to sit there and scratch their head and say, well, I don't know. What do you want to buy? They're going to immediately jump on their computer and say, look, our home office or New York office research department, those guys are telling me that you should buy ABC stock because this is a good stock. Look at this. It has a great price earnings to rate ratio. Look at the revenue on it, and you've probably heard of this stock, and so he's like, oh yeah, it makes sense. Just look at this big firm. They must know what they're doing, and you end up buying. So that's what research departments do in large financial institutions. Even if they can't beat the market, they got to have that service of recommending stocks. Now, that said, now that I just told you about efficient markets and that the market is reasonably efficient, let's start looking at the question mark that I posed at the beginning of this video, where I said, efficient capital markets, well, we should think twice about that. And that's where the idea of market anomalies come in. Market, E-T, anomalies. Anomalies are things you can't explain. And so what I'm going to do is talk about some patterns that people have found in the past that suggest market inefficiency. They suggest that people can beat the market if they look at these patterns and trade based on these patterns. And so that's why they're considered anomalies. They have the appearance of market inefficiency. But let's talk about them. And in this discussion, you'll gain more insight as to the questions you ought to ask when it comes to people claiming to beat the market. Okay, the first form of market inefficiency, or I shouldn't say that. I should say the first anomaly is the small firm anomaly. Okay, small firm effect, as it's sometimes called in the literature. It says that risk-adjusted returns for small stocks tend to be higher than for large firms. Okay, now let's back up a second. Risk-adjusted returns tend to be higher for small firms. Well, at first you'd say, well, returns ought to be higher for small firms. Small firm returns ought to be higher than large company stocks because small firms are riskier. They're not as diversified. They're in markets that are relatively new. And so you would expect small firms that bear more risk. Okay, so you would expect, in the world of finance, the more risk you take, the more return you ought to get over the long run, and you should be able to see that historically over the long run. Now, what we're saying here is that may be true. Small firms in fact, small firms do beat the market over long time periods because they are riskier. But what I'm saying here and what this effect is that risk-adjusted returns for small stocks are greater than large stocks, which doesn't make sense. Once you adjust for risk, all firms should be equal. And so you shouldn't see this anomaly. So what it's saying is, look, if even on a risk-adjusted basis small firms do well, then why don't we do this? Why don't we just load up on small stocks, right? And we'll outperform the market. That sounds pretty plausible, right? It does. But keep in mind that when you look at these risk-adjusted returns, and you load up on small company stocks, you're loading up on a pile of risk. You're looking at small companies, they're probably thinly traded, their bid-ask spreads are probably quite high and wide. And so these stocks, by their very nature, have a lot of various kinds of risk associated with them. And if you form a portfolio of small stocks, you'll get some diversification, but you're also concentrating yourself in this small stock risk. And so the question becomes, maybe we can't measure risk properly. And I think that's an extremely important question. It's probably a very accurate one. So remember how you calculate risk-adjusted returns. Risk-adjusted returns, one way to calculate the risk-adjusted returns is you take the return on a stock or a portfolio, the average return over a period, minus the risk-free rate. So this difference here is a risk premium. So if a stock has a 10% return and a 2% risk-free rate on average over the time period, it's an 8% risk premium just for taking risk. This already reflects the opportunity cost of money. And then you adjust it for risk of the stock or the portfolio. And so risk goes on the bottom. So and this is a measure of total risk, recall. Sigma measures total risk, how variable your stock returns are over time. And so if your risk is high, it drives your whole return, risk-adjusted return down. And if your risk is low, it drives it up. Now, what happens if we can't compute this measure of risk, a measure of risk properly? So we compute standard deviation, but there's nothing to say that standard deviation captures all the different dimensions of risk. So the point that I'm saying is this. We can calculate risk-adjusted returns, but if we don't know how to measure all the risks associated with small stocks, this is not doing a very good job of measuring risk, which means our risk-adjusted returns are not properly measured, which means when we look at risk-adjusted returns from small stocks to large stocks, we probably have a problem there. We have a problem to be able to do the comparison because we can't evaluate risk properly. If you look at large stocks, which have much less risk, their spreads are much lower, they're very liquid, there's not a lot of risks, so maybe there's not a lot of measurement error in large companies' stock risk. But when it comes to measuring risk of small stocks, it could be quite high, which means our risk-adjusted returns are contaminated. You have to keep that in the back of your head when you think about this. Okay, now that's one form of anomaly. That's one form of anomaly. Another form is called the price earnings effect. It's called the PE effect. I'll just call it the PE anomaly, price earnings ratio. And you know what a price earnings ratio is. It's price divided by earnings. Now, as we'll learn in a later chapter, you need to put some subscripts on this because you need to define price carefully. You need to define earnings carefully. Price is almost always, when you look at these ratios, time zero. Right now, time t. You can call it, if you have a timeline, start out at time zero. This is today's price, today. Okay. And the earnings are often backwards looking, and it would be the last year's worth of earnings. So it would be earnings covering this time period here. So you're looking at the stock price right here, time zero, but you're looking at the earnings over the past year, and that's the denominator. And so that's kind of a not quite accurate way of computing a price earnings ratio, but very, very common because most but not all people can agree what the earnings of a company were during the past year. And I say they can't quite agree, that they can kind of agree on what the earnings were last year, but remember, you're looking at this price to earnings ratio as a way to scale the price, and you really are trying to use it to forecast the future. And if you're looking backwards with earnings, then this price itself is looking forward. These earnings are looking backwards, and so it's not quite consistent ratio. Okay. There is a leading PE ratio, as we'll see later, and that would be earnings over the next year, an estimate. So I should put a little caret here if you can see that. I'll put a little caret over to E, meaning it's an estimate of earnings. Let me draw it a little nicer, write it up. This would be what's called a leading PE, and that's where the price looks forward and the earnings look forward also. So it's consistent. So what's a price earnings ratio have to do? Well, with anything here, price earnings ratio is probably the easiest valuation model out there. It's the most common because all you got to get is two numbers and divide them, and you've just scaled price by earnings. So think about it. So I call these scaled returns, and your textbook will call these things scaled returns when you look at ratios. And what does it mean by scaled? Well, think about it. Price by itself tells you nothing. If you compare two stocks, one's $100 and one's $3, $100 and $3 tells you nothing about the underlying stock. If you look at the earnings of a company by itself, and one stock earns 25 cents a year and another stock earns $3 per year, tells you nothing. But when you compare the stock price, which is on a per share basis, with the earnings per share of the company, now you have something. You can scale price by the profitability of the company, a part of its fundamentals of the company. And so it starts to make sense here. And so the way the market works with this is, the way the market thinks is, when you have high PE ratios, so let's look at a PE ratio here. Doesn't matter. I'm not going to put the subscripts on there at all. It doesn't matter. But when you have a high PE ratio, what it means is the price is high relative to earnings. Because price is now relative. It's relative to earnings. If prices are high relative to earnings, you have a high PE ratio. most people would interpret that as being that a bearish sign. Well, not bearish. It would be interpret that as being the stock is being overvalued. It's not a good buy. It's priced too high relative to its earnings. And if you come across a stock with a low PE, it means its price relative to its earnings per share are low, and that it's probably a good buy, is the way a lot of people would interpret it. Okay, but now you got to ask, well, let's see. You got a low PE ratio, and it means the price is low relative to earnings. Well, why is that? Well, it could be that we're looking at a lot of risk, that the stock has dropped because people have dumped it because it's quite risky. Okay? So what this anomaly is talking about here is that low PE stocks tend to outperform high PE stocks. Low indicating undervalued and high PE indicating overvalued. And so that low PE stocks outperform high PE stocks. But then again, remember, if you did a strategy of buying a bunch of low PE stocks, what are you doing most likely? You're probably loading up on highly risky stocks. The prices have been beaten down relative to earnings for some reason concerning risk. And so that when you look at the PE ratio and you buy low PE ratios, you're loading up on risk and you would expect a high amount of return. Well, even on a risk-adjusted basis, this anomaly shines through, comes through. And again, it could be because, again, if we do risk adjustments and we don't quite know how to adjust for risk, then we've just contaminated our risk-adjusted returns and we can't really do good comparisons. Okay. Now, it turns out that a lot of these, as we go through, we just did the small firm effect, the price-earnings ratio effect. I'm going to do book to market. It turns out that a lot of these are interrelated. They tend to be related. And again, the relationship could be because we measure risk improperly. It could be for other unknown reasons. Now, another anomaly is called book to market. Okay, that's book value. I could put a V in here. To market value per share. Now you know what book value per share. Book value per share is the assets of the firm divided or minus the liabilities, which is equity, right? Divided by the number of shares outstanding. That's book value per share. Okay, that looks a lot like a net asset value, by the way, right? Equity per share. Except this is using historical information, historical valuations for assets and liabilities. And so book value divided by market value, and this is market value per share, is driven by the price of the stock. Okay, the current market price, and this is based on historical information. So what we're doing is we're scaling market value by book value. And it's somewhat flipped compared to price-earnings ratio. With a price-earnings ratio, the market value is up top and earnings are down below. In this case, the market value, which reflects prices on the bottom, not a big deal. But the way you interpret this is that the way the market interprets is this. Stocks with high current book value to market value, right, tend to perform well in the future. Okay. Stocks that have a ratio where this ratio is high tend to outperform. Now, how can this ratio get high? Well, this whole ratio gets high when the denominator drops. So when the market value or the price of the stock gets low relative to book value, it drives this ratio up. Now, why? I don't know why the market flips around between these. When high PE ratio means it's overvalued, but a high book to market, since the market value is on the bottom, means it's not a good buy. I don't know why they flip it around, but you just need to think conceptually how to interpret this, and you'll have it straightened out. That this market value represents price, and when market value is low relative to book value, then that's probably a good buy at that point. Okay. Now, this again may reflect this, and this is an anomaly where stocks that have high book to market tend to outperform, even on a risk-adjusted basis. Again, it could be because we don't know how to adjust for risk. Okay. There's other ways to scale prices, and one way is to take price divided by dividends. So instead of earnings, you take price earnings ratio, you'd use a price dividends ratio. This is often shown to be they often do the inverse, dividend divided by price, and that's called the dividend yield. Right? That's the part of total return we talked about earlier. That's dividend. So dividends per share divided by price. Okay, and so so you can now so you can use this. Some people use this to try to figure out which stocks are better. Now think about it conceptually. If you have a high price on the bottom here, that means your PE rate, this dividend to price is low, right? That means that would imply when this ratio is low, the stock is overvalued. Okay, and so when you have a high dividend to price, when this is high, it's because the price is low. Then this would be an undervalued stock, and you'd want to buy a stock. You'd want to buy a stock with a high dividend yield. That's what that's saying. You want to buy a stock that has a high dividend yield because the stock is undervalued. But why would that be? Why might a high dividend yielding stock be a good buy? Well, it may be an illusion. You may think of it as a good buy, but it could be a highly risky stock because people drop the stock price and dividends remain unchanged for a period of time. The dividend may not change for a quarter, or it's relatively sticky and prices bounce all over. So maybe you just load it up on some highly risky stocks. Okay. The next anomaly is called the January effect. It's January effect. And the January effect says that stock returns tend to be high in the first 10 days of January. And again, like all the other anomalies, this can't be explained. Why would, think about this now. Why would stock prices in January be so, the returns be good in the first 10 days? Well, some people look at it and say, well, a lot of people get bonuses at the end of the year, and they take those bonuses and reinvest it in the market early in January. Possibly. Other people think, well, there's all sorts of tax manipulation going on, and so maybe people sell their losers, take the capital loss, that reduce their taxes, and turn around in January buy stocks. And so, okay, that kind of makes sense, but the research indicates that can't explain the whole January effect. You have to ask yourself, okay, look, people in Wall Street know this January effect. We've known this for years. You see January effects in other parts of the world, in other countries. You see a small stock effect in other countries. You see a PE ratio effect in other countries. All these anomalies, they show up not only in our markets, but many of them show up in other stock markets around the world. So you might want to ask yourself, how could these effects and these anomalies stay around when they're very well published and people on Wall Street know about it? So you think, okay, if stock returns are going to do well in the first 10 days of January, why don't I start buying them in December and take advantage of it and ride the crest of the wave up until through beginning of January and then sell? In which case you wouldn't have a January effect anymore. You would cause a December effect. And then if you had a December effect, right, a late December effect, people say, well, I'm going to buy early December and wait for the stocks to go up in late December and just ride that wave. So you'd have an early December effect. And so you see, these anomalies don't quite make sense because it's publicly available information. Small firms, everybody knows what small firms are, so why don't everybody load up on small firms and drive up those prices and negate the small firm effect? And why don't people buy low PE stocks and negate the PE effect and so on? There's no good answer to all this, which is why we're talking under the context of market anomalies. It's an anomaly until you start asking, like I said, the question, could these stocks be, the January effect be related to risk? And it turns out that many of the stocks from the January effect are small stocks. So it's kind of connected to the small firm effect that I started out with in this section. So keep that in mind. There's connections here. Okay, the last anomaly that I want to talk about is the overreaction hypothesis, which I think is a pretty neat hypothesis. And the overreaction hypothesis basically says, look, people, we're humans. We tend to overreact. We overreact especially to bad news. We're more likely to dump stocks on bad news, dump them, and then ask questions later, so to speak, in which case you can drive stocks down quite dramatically. Or you can work in the other direction, but not as common, and push stocks up on good news, and it push too far. And so that's the question. How do you know how far should a stock react? And how do you know when it's an overreaction? Those are good questions. But I don't necessarily have an answer for it. It would depend on the situation. But people try to develop trading strategies based on this overreaction hypothesis. And a really good example is called the Dow Dogs. That Dow Dogs, there's many forms of the Dow Dogs strategy. The Dow Dogs basically say this, look, the Dow Jones Industrial Average is made up of 30 blue chip stocks. They're almost all household names. They're big multinational businesses that have been around a long time in stable markets. And out of the 30, there's always going to be a few over a course of a year that will do poorly, or at least poorly relative to the other Dow stocks. And those are called the Dow Dogs. And so what this anomaly says, the one way to take advantage of it would be to buy the Dow Dogs, buy stocks that have done poorly in the Dow Jones Industrial Average, buy them, hold them over the next year, and you'll outperform the market. Well, then again, why would you outperform the market? Now, you know the answer is it could have been that you loaded up on out of all, if you sorted all the stocks in the Dow Jones Industrial Average, you probably loaded up on the riskiest stocks in the Dow. That's why they're the dogs. And so over the long run, you would expect to be able to beat the index as a whole because you've taken on more risk. Now, credible research in the world of the stock market is coming down there to realize that there is some predictability in stock prices over the long run. And how much you can try to take advantage of this is how economically valuable is this predictability is an important question. So there is some predictability, but the economic value is not very well known in my opinion. But the predictability looks like this. It's a little complicated. So I think the best way to do it is to draw a picture of what I'm talking about in terms of stock returns. So this credible research says that over the long run, stocks have some predictability, but in the short run, they're almost completely unpredictable. And so the way to look at this, and I'm on page 5 of my notes here on the empirical research, it's basically this. Stock prices over the long run tend to follow cycles. I mean, when I say over the long run, I'm going back to just after World War II. And you got to go back to World War II that far with stock returns because you need as many cycles as you can from peak to peak, to trough, so to speak. You need as many cycles because a cycle is a sample. It is one observation in this type of logic. Remember when you took statistics and you needed to have a sample size of 25 to 30 to start having a valid sample size. Well, when you start talking about economic cycles and how they affect the stock market, if you have one cycle, one peak of an economy to another peak, this peak may last 5-10 years, in which case you got to go back a long time to get a reasonable number of observations. So what this research is saying is, look, there is a cycle in the economy. We know that it's called the business cycle, and that cycle influences the stock market. And so I'm drawing a nice, picture here. It's obviously not quite that nice, smooth pattern, but you get the idea that the market's up, it tends to go down, it goes up, it goes down over time. And so from that perspective, the market tends to be predictable over the long run. It's sometimes called negative autocorrelation. So what I'm saying here is that the stock market, auto means correlated with itself. What negative correlation means this: compute a mean and run the mean right down the middle, like this. You're above the mean, you're below the mean, you're above the mean, you're below the mean. When you're above the mean and you sample in this time frame and you're below the mean, you're above, you're below, and then about the same time frame, you're above and then you're below. That's negative autocorrelation. So what it says is, over these time frames, when you're above average, the next time you're going to sample is going to be below average. And when you're below average, the next time you sample is going to be above average, and then below average, and then above average. That's predictability, but it's predictability over the long run. And that's called negative autocorrelation, meaning you're up and then down, up and down, up and down. Okay? So what we're saying is that there's patterns but they're very long-term patterns. Now, the unpredictability in the short run, unpredictability means that, look, there is a lot of noise in the stock market over the short run. And so the market's going up and down, up and down, up and down, and it's quite hard to figure out where is it going next, because it's gyrating on a random, almost random, and this is not random, by the way. What I'm doing here is not random. It's quite predictable, but it's not what I mean. But I'm just trying to tell you that there's unpredictability in the short run, and that unpredictability, which is caused by news, right? It's caused by short-term news that's going on in the market. One day there's good news, and the next day there's bad news, and you experience this just playing stock track over the semester. Good news, bad news, but keep in mind that it's good news or bad news in the context of a much bigger business cycle. And this semester we may be in a very good, strong market, and so you got these little ups and downs when you're above average and in an economic boom. But you can have this sometimes called white noise, this unpredictability, when the market's down and you're in a recession. So this type of short-term movement is sometimes called positive autocorrelation, because when you're above the mean, you're going to be above the mean and above the mean and above the mean, above the mean, above the mean, above the mean, above the mean. So when you tend to be above the mean today, you're going to be above the mean tomorrow, most likely. When you're below the mean today, you're likely to be below the mean tomorrow, and so on. So that's called positive autocorrelation. That's basically what the credible research does. But it does this it's not really looking at stock prices per se. It's looking at stock returns, which are scaled by past prices, and also using those ratios, PE ratio, book value to market value, book value to market value, and also dividend yields and so on, scaled prices. So when you look at these scaled prices over time, the business cycle shows up in these scaled prices. And so these scaled prices show patterns that reflect the business cycle over the long run, but they also have a lot of noise in the short run. And that noise overwhelms, that short run noise overwhelms any predictability that you can get over the short run, which is why they're saying the market is very difficult to predict in the short run. Okay. Now, at the bottom of page 5 of my notes, there's an important, very, very important concept that you need to realize about this, and it asks the question, does predictability in the stock market imply inefficiency? Wow. Okay, think about it. does predict, if there's a predictable element of the market, does it imply the market's inefficient? And the answer is no. And this may seem counterintuitive, but let's think about it for a second. And I can tell you from personal experience, maybe you were around and invested back in 2008, 2009, 2010. But back then, the stock market was down. So here you have a down cycle. Let me give you a better representation of what that cycle looked like. We had a good upturn in 2005, 2006, 2007. Then we took a dramatic, falling off the paper here, drop, and then the stock market rebounded, and it's well above where it was in 2007. So if it was here in 2007, in 2015, we're well above that point, at least for the Dow and the S&P. We're well, in fact, I'm running out of paper. It would be even a little higher than that. But the point is, the stock market was in the tanks. The stock market on average dropped about 60%. This was a 60% drop over maybe a year and a half, something like that. 60% drop, negative return. And I knew when this happened, I'm sitting here, 2008, 2009, I'm sitting here, and I know I've been investing since the early 80s and been following the market since then. I knew this was a time to buy. I knew that stocks were cheap. But the circumstances were such that I also knew that there was a lot of risk buying at this. When you're buying here in the bottom of in a recession, in the Great Recession as we call it, that there's a lot of risk. It takes a lot of guts to be able to buy stocks when the market's down like that. You're looking at a point when nobody wants to buy. People are scared to death. That's why the stocks have fallen so much. You've got to really have a good stomach to start plopping money down and buying stock. But it's an example of predictability. And the point is this. There is predictability there, but it doesn't mean the market's inefficient. There's predictability there because risk is extremely high. When risk is high, people sell stocks so that the risk-adjusted returns balance out at any given point in time. And so the point that I'm saying is there can be predictability, but it doesn't mean that the market's inefficient in those circumstances. Now let's talk a little bit about the rational investor. Most of the models in finance assume a rational investor. It's easy to model, well, it's relatively easy to model a rational investor or a rational economic agent in economics. What's harder is to model irrational behavior. I mean, irrational behavior is hard to model because there's no limits to how irrational people can be. So it makes it a bit difficult. But we should talk about the assumptions we're talking about when we deal with a rational investor. This terminology and the concepts pop up in the next chapter under the Markowitz's modern portfolio theory. But let's look at some of the implicit and explicit assumptions, behavioral assumptions that we make about investors in much of this course that we should be aware of, because in reality, investors are not rational. They are I'll say it again. Investors tend not to be rational investors, but it's hard to model the rational investors. So you got to try to start easy. You know, when you want to analyze a bridge, engineers want to analyze a bridge, they build a model of it, right? And so they simplify things to make it easier. You don't want to build an entire bridge to scale to analyze it because it's just the effort's too much. So in finance and economics, we assume rationality so that we can come up with some reasonable models of how the market ought to work, how it should work. And it's really important to think about how the market should theoretically work versus how it actually does work, because then we have in our minds a benchmark as to how things ought to operate. And when things deviate from how things ought to operate, we should know why. We get a lot more intuition as to how markets work that way. So getting back to these implicit and explicit assumptions, what are they? Well, we will assume that investors are risk adverse. We explicitly assume investors are risk adverse. It's going to pop up in the next, very early in the next chapter. And it's a reasonably good assumption for nearly most people in the stock market. Most people are risk adverse. There are some people who are gamblers and love risk and take additional risk and not too concerned about the return. But we'll shy away from those people. It's a small percentage of the people. But what risk aversion is saying is, look, if you take on more risk, the typical investor is going to demand a higher expected return, which is what you ought to be doing. So when you show me your asset allocation, for example, in StockTrack for your StockTrack report, and you show me small cap stocks, mid cap stocks, and large cap stocks and your expected returns, your expected returns from a rational perspective ought to be the small stock returns. Your expected returns for the next year for those small stocks should be higher than the mid cap stocks, which should be higher than the large cap stocks, because large cap have the least amount of risk compared to a mid cap and small cap stocks. So you're taking, when you buy small stocks, small cap stocks, then you expect a higher amount of return because you're risk adverse. That wasn't always the case with some of your examples when I graded the StockTrack papers. Okay, item 2 is investors analyze new prospective investments properly, but considering their impact on the overall existing portfolio. In other words, they can integrate prospective assets you're considering to put into your portfolio easily and carefully. And it turns out that's an implicit assumption, but it turns out to be violated all of the time. I mean, nearly all of the time. I see so many people look at stocks with blinders on. I want to buy this ABC stock, and they're looking at it, and they're looking at it, and looking at it, and they forget to look at the competition. They don't know how it's correlated with the market, and some very important ideas that are going to pop up in the next chapter. But that's actually irrational behavior, because you need to look at how does this stock behave relative to the rest of my portfolio. That's an important question in terms of measuring risk. Well, again, we'll pick up on that in the next chapter. The third item is investors make and view decisions about risk that are consistent with standard deviation and variance. That's an assumption that we're making explicitly. We're making the assumption that standard deviation, and in some cases, then later on in the text, beta properly measures risk. And I just got done telling you through most of this video that risk, our idea and ways of measuring risk are not very good. Fourth item here, investors have rational, accurate, and unbiased expectations when forecasting. That's an implicit assumption, but we know that that's wrong. We know that investors often behave irrationally. They don't look at fundamentals when they trade. A good example would be the greater fool theory. You're buying a stock and you're thinking, I'm going to buy this stock because I know people are going to want to they're going to want to buy this stock from me at a higher price. I know the stock price is going to go up and I'm going to sell it at a profit. What you've just said is, look, I'm ignoring the fundamentals of the company. I haven't looked at them. I don't know much about the company. All I'm hoping and pinning my hopes on is that there's a greater fool out there that's going to wait for the stock price to go up and pay and fork over money to me for my stock. That's the greater fool theory. That's an irrational way of thinking of the stock market. We also have saying here that investors are rational, they're accurate and unbiased expectations. There's a lot of literature on that's published research on analyst expectations, because analyst expectations get published quarterly. even and updated quite frequently. And so people backtrack and they look, okay, what did these analysts predict for Apple's earnings and for Apple's stock price in the future? And they go back and they look at the bias that's in these estimates. And the bias is almost always on the upside. People are intrinsically optimistic, especially analysts that follow stocks within their industry. They're overly optimistic. And that's quite an interesting observation. And something you should realize is that you should be probably a little more skeptical, a little less biased in your predictions about where the market's going. And that's really one of the biggest things you should learn about this chapter is when you get through this chapter, you should be able to ask questions that are really good to anybody who says they can beat the market. And you ought to become a professionally skeptical about claims that people can beat the market and they do well and they understand the market quite well, and so on and so forth. You can be professionally skeptical after you take this course and especially look at this chapter. The fifth one is investors are quick in updating their beliefs in response to new information. That's explicit. That's semi-strong form we just talked about. In some cases, new information comes out, people react to it. It turns out that people get new information and often don't respond to it for whatever reason. The sixth item here about the rational investor assumptions is that the way in which choices are framed is irrelevant. We implicitly assume that the framing of a question, how it's framed, is irrelevant. And it turns out that it's not, that it's important how you frame questions. So interestingly, it turns out that investors are not always risk adverse. They analyze each investment separately rather than collectively. They view risk differently than is captured by standard deviation and variance. They often have expectations that are not rational. Their forecasts are often biased and inaccurate. And they're slow in updating their beliefs in response to new information. And they make decisions that are dependent on the way the questions are framed and the information is framed. So all of this signals that people are really not rational investors as we try to model them in finance and economics. Like I said, that doesn't mean that you should throw out all the models that we're using in finance. Those models are extremely valuable for benchmarking, mental benchmarking. And so when you see deviations from those mental benchmarks that you have, you can ask yourself, why is that? Does this make sense? And should I go after this investment knowing this information? The next couple of pages of my notes, pages 7 and 8 of my notes, I'm not going to go into detail. Let me just summarize it this way. It turns out in reality that investors tend to be risk adverse when you're looking at potential gains. When you're looking at making money in the future, you expect gains and you're faced with gains in the future. People tend to be risk adverse in their behavior. But when people face losses, they will actually gamble to get away from a loss. Let me give you some insight into what I mean by people are loss adverse and they steer away from losses as much as possible. Let's say that I give you two scenarios. There's a 100% chance you're going to lose $8,000. That means for sure you have to pay $8,000. That's one situation. You can choose that situation, 100% chance, so you basically have to write a check for $8,000. Or you could gamble. There's an 80% chance that you'll lose $10,000 and a 20% chance you'll lose $0. Okay. Now notice the expected value of this equals the expected value of this. The expected value is 8,000 here. This is 0.8 times minus 10K plus 0.2 times 0. And so that is 8. Or I just add the zeros, 8,000 loss. Okay, so notice these two scenarios have the same expected value. But what would you do if we were faced with this? Would you just surrender and say, look, I'm going to pay $8,000 for sure? Or would you take a gamble, roll the dice, so to speak, with an 80% probability of writing a check for $10,000 and a 20% chance of losing nothing, unchanged? Nearly everybody would go for the gamble. That's an example of loss aversion. People gambling to get away from a sure loss. It's not uncommon to see that in the markets. So let me see if I can make this loss aversion concept hit home. Let's assume in stock truck you lost $100,000, and you kind of think of that as a 100% loss, because you actually realized you have a loss of $100,000. It actually has happened already. So you're thinking to yourself, oh man, how am I going to dig myself out of this hole? So you're thinking, okay, I'm going to go into some oil futures, or maybe some gold futures, where I'm going to have a 50% chance. Maybe I'm going to hit a home run and make $200,000. But there's a downside to this. I could lose $400,000. Right? And so if you look at this, this has an expected value of minus 100,000. Okay? So you're looking at this, it's like, what would I rather do? Face a for sure loss, which I've already realized that it's happened already, or should I gamble, possibly making 200,000, bringing me up to $1,000,001, for example, $1,100,000. I could be the winner in stock track. Or, look, I'm already a loser. I'm already one of the biggest losers in stock track so far. Losing another 400,000. Well, I'm okay. I'll have to live with that. I'm going to try to dig myself out. So what do? You gamble away from that. You steer away from this, and you take the gamble. Instead of staying with this, you take the gamble.